welcome back to Crypto, my God, and oh my God, what's happening? I mean, I think it's okay. We're kind of in a bottomy ditch thing. Tariffs are going on and off, and what would be really useful right now is just a lightning rod for how can we attune ourselves to the market, and that's what I want to cover today, so let's hop into it. All right, so the topic I want to just dive into, it shouldn't take too long, it's going to be a short and sweet video, but this is funding rates, and these are a very solid way to intuit what is happening across the broader market, basically a way to step back and look at the market that sits on top of the market. And what do I mean by that? Which is, what are traders paying each other to hold long or short positions? So this is something that we can use to, again, intuit the more macro moves of the crypto market. And this revolves around something that is more crypto native called perpetuals, Perps for short. And this is something that is unlocked by the 24/7 nature, the digitalness, and really does reflect the broader mechanisms of the market itself. Now, I've got a bunch of content here that can explain this more in depth. I'm going to try to provide a really high level. I want to unlock your curiosity. But what are funding rates, right? Look, key takeaways if we just want to go for the beginning of the blurb from Cointelegraph. Funding rates are payments that help keep trading fair by aligning futures and spot market prices. This is really the core of it. Basically, we have these option markets like the CME, the Chicago Mercantile Exchange. Binance offers these things as well. Now, futures, they have expiry dates, and these are generally far out, right? They're either every month or quarterly or something to that effect. Now, crypto does not really fuck around with long-term dates, right? We don't like these things that close in chunks. We are a 24/7 industry, block by block. The internet is always on. So we sought a way to create a product around crypto assets that correlates to the options, but in a more always-on format. And that is Perpetual Futures Contracts, Perps. So just to run down this list of already made content, thank you Cointelegraph, crypto funding rates, explained simply, are a way of helping balance the market by adjusting the cost of holding long and short positions in future contracts. And what we really begin to see here is we can get an entire market view of, again, what are traders that are doing futures, that are doing the future outlook of these asset prices, actually putting out in respect to what the prices are right now. How can we look at the expectations around these institutional buyers, these whales, these people that are not really looking to buy and hold crypto, but are trading in a short time frame on broader market dynamics? When we look at perpetuals, we're really getting into a futures pricing spread. So this is a very simple graph, sort of how we can look at the time value of expectations versus where we are in a contract closing, right? If the expectations are that the price is higher, contango, backwardation being the expectation is lower. These are all going to converge on a price at the time of closing. That is how a futures contract works. However, in these expected periods, we do have this spread, right? If this is the median here, you have a spread to contango upwards or downwards. Now, this is where perpetual futures come into play. You're basically going to pay the market in order to take one of these two positions, right? The concept behind perpetual futures is if that everyone starts to collect around a certain side, long or short, there is going to be a cost associated with this alignment. Now, that cost is used as an incentive to take the other side of that trade. A market will break if everyone just falls into a single camp, right? You need a buyer and a seller in a market. Now, what perpetuals allow you to do is to take a position either in the over or the under at a cost or an earning. This is really based on the risk profile. And perpetuals are a little bit confusing because they're slightly inverted. Let's talk about Bitcoin. And let's say the market is getting very negative. Let's go with what we're seeing right now. Everyone thinks we're in a dump. So shorts begin to pile on. The futures contracts move towards cheaper price tomorrow than it is today. The difference with perps is that they're highly liquid. You can enter and exit a perp at any given time. The trade-off in an options contract, you pay a little bit to open or close that contract. In perpetuals, you are going to be paying a recurring fee. So in the case that everyone hops into a short position, that fee is going to increase. If you want to join them in that perpetual short, you have the luxury of entering and exiting at your own whim. But the contract itself, the Perpetual Futures Contract, is going to charge you a fee. And that fee is called the funding rate. Now here I have a chart open. It's live right now. I'm going to just talk about Bitcoin really quickly. You can see that we have these positive and negative numbers. They're all fairly small, right? These percentage rates, these fees are not enormous, but they can scale. They can go up, they can go down. Now a positive funding rate, if we see that number without a negative in front of it, it means that people are going long. And in order to do that, they are paying shorts to maintain that long position, right? There's basically a cost to doing business. And the funding rate reflects the majority. If we find a balance, there really won't be a funding rate because no one is looking to take leverage, to take a position in which they can get a larger payout. Again, something that would cost capital in order to open. So if everybody decides that they're going to go long, we will see a positive funding rate begin to increase. The more people that go long, the higher that rate goes. And this is something that they will have to pay. In exchange land, I believe they pay about once every 8 hours and then the rate re-rates. However, there is a cost, and that will come in 8-hour chunks in order to keep that open. Obviously, the more people that kind of collude around a long position, the more expensive that's going to be. You need somebody to take the other side of that market. So any sort of short seller could open that position in order to get paid by the longs. That means that the more people that go long in this situation, the more incentive there is for someone to open up a short position. Again, you don't want everyone taking the same side of a trade. It breaks a market. Now, conversely, if a funding rate goes negative, it means that people are starting to coalesce around short positions. And again, if everyone thinks that the price tomorrow is going to be lower than it is today, a cost is going to build up around that position. Whenever we get consensus in a market, consensus is dangerous. It comes with risk. It means that there is no edge, there is no alpha around it. So perpetuals seek to adjust and compensate for that. If everyone begins to go negative, the negative funding rate begins to increase, technically decrease, we're going downwards, but that means that shorts begin to pay longs. Again, this is a market mechanic to help adjust this curve. If we go too high into the long, it becomes very expensive to hold this here. So you have to be very confident that you're going to win this trade because you're paying money 8 hours by 8 hours in order to hold this. Same with the inverse. Now, this also creates an interesting opportunity for arbitragers, which if I see everybody in the long trade, I could just go and buy that asset, right? If I think it's going to go up, but I want to capture that fee, I want to provide some structure to the market, I can purchase that asset, which means I'm taking a long position, right? I hope that it goes up more tomorrow. And then I open the short position against the same amount of asset, but I get to get paid by the longs. That funding rate comes to me. This is what Athena, the coin, is doing around Ethereum, which is basically taking this trade and wrapping it in a single asset. This is how they generate the yield. Now, this becomes a mechanic as we begin to look at it. And when we open up the broader market, we can see here that funding rates are broadly negative. This is telling us that across these assets, and of course we have the different exchanges, we have Binance, OKX, DYDX, Bybit, but just in general, we're looking at negative funding rates, which again means people are around the short side. The majority of market participants are willing to pay money to take the short position. This means that they think the price tomorrow will be lower than today. So this is a really useful tool to begin to read into. I am using Coinglass right now. Now, something to note is that these rates actually go hand in hand with open interest. Open interest is how much capital is being held in these future contracts, right? Basically, open interest is a number to reflect that. Now, this is leverage. Open interest can kind of show you how much leverage is building up inside of the system. And this can be dangerous, right? If we see open interest begin to spike, if we see an aggressive move in one direction, we can really see the setup for these long squeezes, these short squeezes, and maybe we either want to participate in that to try to catch that trade, or we want to say, hey man, this volatility is looking a little scary, maybe I want to back out. Now, the one thing to consider is that these perpetuals, the way that they operate is that people do put up capital, which they lever, right? So a 10x leverage bet on $1 for Bitcoin gives you a range of trading value. If you leave that range, you get liquidated. The risk for being able to lever up is that these algorithms can take your underlying capital. So if I bet my $1 of Bitcoin and I go outside of my range, it will close that trade, it will take my $1 of Bitcoin, and I am left with zero. This is how the exchanges make tons of money. It's an amazing feature for trying to, again, balance out the futures and create arbitrage opportunities. And it does seek price stability, again, by creating the costs for going either aligning with the market or going against it. And those costs create a secondary market for arbitrageurs to take advantage of. All of this is to find more ways to find the maker-taker, the buyer-seller side of any market, and keep them alive and healthy. So this is something I recommend you familiarize yourself with. I don't usually talk about trading, but in times like this where things are very fearful and you want to better intuit what the hell is going on, learning funding rates is just a nice way to at least understand the macro of the markets a little bit better. So with that being said, guys, I mean, I myself am a core technology investor. I like to buy and hold assets that I believe in. I find it much easier. You will find if you ever open up a Perps contract, it's very hard to go to sleep on it. I would never leave it open while I am not directly paying attention to it. In many ways, I find these things to be life ruiners because you can easily become obsessed with these. And it is through this that we actually see the leverage pile up that causes these violent moves. So many times I just wish people would buy and hold the assets. It would make life much easier. And of course, you can actually see the volatility of the Bitcoin market change after January 2022 when the perpetuals markets begin to open up. It's one of the reasons we don't see the aggressive spot accrual that used to occur when people could only buy and sell Bitcoin, for example, buy and sell Ethereum. Now, market maturation, which is what these are, should level out volatility. And realistically, we should start to see a minimization of the four-year cycle. These are tools to resist, again, these giant pumps, these giant dumps. This is all about price discovery. It's on a minute level. It is much more specific. And again, maturation, more tools that are coming into the crypto industry to do what is called appropriate price discovery. It's very practical. I'll add some links that give a really good overview. I think Coingecko actually put out one of the better videos I've seen. But again, this is just another arrow in your quiver to better understand what's happening. You know, if you are going to invest in these things, you might want to look at what the day traders are doing, how the market is being manipulated by large capital. And of course, tools like this will begin to be taken advantage of by the banks as they're allowed to open up to the cryptocurrency industry. And more capital in these markets means less violent moves, again, better price discovery, and hopefully we see a flatlining. Now, the inverse is that crypto actually portends the future of the stock market, and as the markets move towards 24/7 trading, like the NASDAQ just announced, maybe it could be that high-frequency trading and bots move the stock market into more of a cryptocurrency territory of high volatility, extreme reaction, and these sort of cascades of information as bots trade on top of bots. Now, my hopes is that we, again, meet in the middle, just like we saw in that chart around futures and price discovery. But this is a fantastic way to grok what the hell is happening on a broader level. As always, guys, good luck out there, and I'll talk to you tomorrow.